Today I'm joined by Brian Daly, CEO of GROUNDFLOOR. Welcome, Brian.
Hey, great to be with you.
All right. So my understanding is that when you were attending Harvard doing a joint degree in law and business, this was a time period when the dot-com was was at the height. So what was it like during that period, and was Silicon Valley beckoning you?
Well, it ultimately succeeded. When I graduated, I went out and I joined Excite at Home, which was the Excite.com portal mashed up with the At Home network, which was, in cable broadband. It's kind of the progenitor of that. So ultimately, Silicon Valley did lure me away. I graduated with $200,000 in loans, which is basically like having a mortgage but no house. So I had to go get a real job instead of being a founder. That said, while I was in school, it was interesting because the late 90s, it was a wild time. I started 3 companies while I was in school, kind of worked on 3 different startups. The last one was funded by NEA. My co-founders went forward with it, and actually were pretty successful with that startup. I was sort of envious, looking from California at it. But yeah, there were crazy days. We had Jeff Bezos in our class telling, 80 Harvard Business School students telling them why Amazon wouldn't be able to expand beyond books and it wouldn't work. And, it was a really neat time to get to observe the dot-com sort of phenomenon.
Yeah.
It was awesome.
Wow. Interesting times, and we rarely get those. We saw a little bit of that with cryptocurrencies a couple of years back.
Right.
And of course, marijuana. But those come few and far in between. Now, you start to kind of allude to it, which is that you started 3 startups during your grad school program,
Yes.
I think 25 or so, 26. But then you didn't actually start this GROUNDFLOOR until in your 40s. So tell us about that journey and, of course, paying the student debt.
Yeah, well, for sure. Fortunately, I went out to Silicon Valley, got a hold of some stock options, got lucky in residential real estate, buying my first house. And that's how I solved my student debt problem. Everybody finds a way, right? But I really wanted to get back to being a founder. I just knew that at that stage of my life, it wasn't the right thing for me. It wasn't right for my new wife, who I just got married to. It wasn't right for sort of my financial situation, but I knew that it was right for me eventually. I just didn't know what path it would take. And the path that it ultimately took is I went sort of from one public internet company to a public wireless internet company, worked on kind of an internal startup there that was really interesting. Got to work with some very talented people who had been acquired into that company. So I had a little bit of that sort of startup founder flavor. I went to work in a Series B deal back east because I wanted to move back east for family reasons, and sort of joined a company that was sort of 20 employees, got to 50 employees, got to 200, went public, which was really interesting. So I saw that. And then I joined a Series A deal funded by Bessemer Venture Partners over in England, and was one of the early management team, 10, 12 employees on that. Went out and unsuccessfully tried to raise a Series B with that team, which was good to see how that went, and what that process was like. So I really got a chance to sort of get earlier and earlier stage through that journey, so that when I came back to the United States and was founder of my own seed stage deal up in Boston that failed to raise Series A, I really sort of had enough sort of times at bat where I understood what the process was like from all stages of it. And I think that was great preparation in my journey. Everybody finds their way. Some people know it at 25, come up with a great concept, link up with a great team, and they're off and running. That wasn't me. It took me a little longer, but hopefully I'm doing it better as a result.
Well, interestingly enough, I think your journey is not that atypical of kind of the median in Silicon Valley and
Yeah.
in New York Tri-State, is that
Right.
it takes kind of into our 30s and 40s before we have the experience, to know-how, as well as a network to actually make it successful. So I think that journey, although it's unique for everyone, is also fairly kind of a median situation. Now let's talk a little bit about.
I think it also takes a little while for people to kind of understand themselves as a founder.
That's a good point.
To sort of have a foundation around that a self-identity, and I had the aspiration, but not the self-identity until I got to a later stage of my career.
Yeah, that's a really great point, because sometimes I think there are a lot of zealous entrepreneurs at a youthful age.
Yeah.
But what are they being driven for, and what's the purpose?
Right.
Versus in your 30s or 40s, or maybe even later, you have a clarity around what you're looking to achieve and why this is a vehicle for you at this point.
Correct. Yeah, and that definitely came into focus for me.
Good. So let's get into your current startup,
Sure.
GROUNDFLOOR. So I'm going to ask a kind of a multi-pronged set of questions,
Okay.
which is how is this different from the usual REITs that are available through mutual funds or ETFs, or the real estate crowdfunding platforms that are out there?
Right. Well, we started off with a very different strategic intent and vision. Our observation at the very beginning of this was that my co-founder, Nick Bargev, and I, was that, I've been investing since I was 14 or 15 years old. I actually like investing. I think it's interesting and fun, and hopefully I've gotten better at it over time. But as an individual investor, I observed that where a lot of the alpha is being produced, the mass market investor really doesn't get access to it. And even if they do, they don't get access to it on the same terms. And so we really set out, we didn't know we were going to be in real estate. We didn't know what it would be, but we wanted to create a financial product for the mass market investor that allowed them to participate in private capital markets without losing their agency. And we thought that was very important from the beginning. So it couldn't be a fund, because fundamentally a fund is a delegation of agency at best. It's a forfeiture of agency at worst. And so we thought capital markets function more efficiently and more effectively for everyone involved when people retain their agency. Now, some cases that's not practical, right? And when we lowered our minimum investment down to $10, we had met many people in our shareholder base and our customer base who said we were crazy, that wasn't practical. But we did it because we thought it would be. We had a hunch that it would be, and we knew it was on mission. Because if you have $1,000 to invest, or $10,000, or we have investors who have $1 million invested, you can build a diversified portfolio that you control. And we think that's an important difference. So it's not a fund. Everything else out there available for non-accredited investors, really, by and large, is a fund. And it is open to everyone. And that's unique. Most of these kind of crowdfunding, so-called crowdfunding platforms are really limited to accredited investors. And we don't think that's a very big crowd. That's about 2 or 3% of the US population.
Yeah. So at the heart of your IP is something called limited recourse obligation, or LRO. What exactly is that?
So under securities law, you have to register an offering or take advantage of an exemption to the rules. Limited recourse obligations are a structure that we built that uses those rules to allow people to invest in our offering and get the benefits of an umbrella offering, right? All of the sort of efficiency of an umbrella offering, but all of the individual choice of choosing your own investment. So a limited recourse obligation says you're going to lend money to GROUNDFLOOR, technically, and we are going to turn around and devote that money to an investment that you choose, and your returns and your ability to recover capital on that investment is going to be dependent upon the performance of that investment. So that's a very specific kind of architecture that allows people to retain agency while getting the efficiency of an offering. Because if we were to try to go register or qualify every single financing that we do, it's a $150,000 average loan size. Well, the audit alone would eat $15,000 of the cost, right? The legal work would add another $25,000 to $50,000, right? You'd spend half of what you raise just on the costs of complying with the rules. So this allows us to go off and raise much larger sums of capital, amortize the costs of complying with securities law over all of those deals and all of that capital. So, every year, I think we're doing about $100 million a year now in investment off of one offering, which is really hyper efficient.
Yep, makes a lot of sense. Now, you guys also obtained Tier 2 Reg A status, which allows for
Yes.
you to be able to market to all 50 states. What is that process and how arduous is it to obtain that status?
Well, it just depends what you're doing. It's more or less arduous depending on the nature of your offering, right? If you are just raising equity as a startup and you want to use Regulation A Tier 2 to do that, it's a pretty straightforward process. There are a lot of people out there now who can help you with it. Putting one together, I mean, it does take some time. You do have to have a financial audit, right? That can be time consuming and expensive. You do have to file an offering circular. The SEC will review the offering circular and come back with comments and questions about it. And you have to comply with the rules for disclosure. So there's some work to be done. And most people will tell you that it takes a few months. Some people say 3 months, some people say 6 months. It'll cost probably $50,000 to $100,000 if it's a straightforward offering. In our case, our offering is kind of novel in that it's not just an offering of equity, in a company. We're using Regulation A for a very different purpose. These limited recourse obligations are novel. It's a novel application of Regulation A. So in our case, we finished it. We're told it might take 3 to 6 months. We finished in month 18 of a 6-month process. It took us quite some time to get qualified for the first time in August of 2015. And at first we were a Tier 1 offering. Now we're a Tier 2. We became a Tier 2 offering, I think, a year and a half ago.
Congratulations.
Yeah, thank you.
Now, let's talk about some of the underlying types of loans. Are we talking about residential mortgage, commercial real estate, multi-tenant?
So when we first started, and I think it's important for every entrepreneur, right, to honor where they started, right? And where you started really matters. Where you started defines a lot about your future, like it or not, right? It creates an inertia. For us, because we didn't have the money to get qualified under Regulation A, and because it was a time-consuming process to do that, we had to start with state rules. And we actually started, there were only 2 states in the country that would let you raise money this way without doing an audit and all of the legal paperwork. There were 2, Kansas and Georgia. So we came to Georgia. We could only fund projects in Georgia, and we could only take investors from Georgia. And so everything we did was very small, and we were only allowed to raise about $1 million a year, right, for projects. So we were really in a prototyping phase. So we needed to find kind of projects that didn't need a lot of capital, right? And so our first loans were $40,000. And we would put 39 investors in these loans here in Georgia. And that got us off the ground. That helped us to prototype the concept. After we got qualified, that average loan size started to climb. But our bread and butter has been a fix and flip, single family residential project that has an average loan size of $150,000 to $170,000 and will ultimately sell for about $250,000 to $300,000. In most of the markets we serve, that kind of puts us at about the first quartile, certainly under the median house price in most of the markets where we are active. And that's actually a good thing. That's actually a great place to be in the housing market. But I think humbly we have to say the reason we're there isn't because of some great, some strategic vision or, grand concept that said, well, that's where we need to be. It's much more a function of where we came from. Now we finance new construction projects in a few selected markets. We also do some multifamily and some rental. So we're starting to expand out from that core. But that's still the bread and butter. The other thing we liked about that sector is all of those projects return capital quickly.
Yep.
So, they return capital on an average of 8 to 9 months. They're generally willing to pay high yields because of the high return on equity that they typically earn on those projects. And that really worked for us in the early days too, because it gave us a nice profit sanctuary to sort of grow our revenue and our profitability. And then it also allowed us to offer great value to our investors, right? They've earned 10.5% on, an average turn time of about 8 to 9 months, which is fantastic, compared to almost anything else in the investment marketplace.
Yeah, I really like the story of the genesis, because to me, it's not just the humble beginnings, but it's actually about market fit.
True.
It's working with a very defined set of constraints.
Yes.
You're working with $1 million a year.
Right.
and you're allowing the market to figure out exactly who is going to be that ideal type of an investor
Right.
profile that's going to fit. It makes perfect sense, and certainly the velocity of the turnover, the
Correct.
payback period, incredible.
Well,
Now,
going
my
back to
understanding
my,
is that you guys make your money off the origination fees.
we do. Yep.
Tell us about who does the servicing, and also on the product itself. Do you guys do packaging, syndication, and any type of derivatives? Because I know you also work with direct access capital.
We do. So we have tried to stay very focused on our mission, which is to serve the individual investor, right? We have been tempted many times to go grab a big bunch of institutional capital, use it to sort of grow our volume, build our vanity metrics, raise a big round, right? We've always been tempted by that, as much as any entrepreneur would. We've largely resisted that temptation. We have started to do some institutional flow agreements where we will originate credit to the standards of one of our institutional partners. And the reason we've done that is to better serve our borrowers. So some of the best borrowers, I mean, in the early days, we suffered from the Groucho Marx problem, right? Which is, hey, we didn't want to lend money to anybody that would take it from us, right? We had like everybody would tell me this business is never going to work. It's an adverse selection problem. No one good is ever going to want to borrow money from you. And they were not wrong about that in the early days. So we had to build our way up past that. But as we did, we started to attract a better quality of borrower. And that borrower wants to do larger projects, or that borrower wants to graduate from single family up into multifamily. Well, we didn't have the resources or the capital base to follow them there. Now we do, because now we have built some partnerships with direct access capital, but also a couple of other institutional partners who buy our paper. And we reserve that for kind of the larger loans that are too big for the retail marketplace. We're also starting to create some hybrid product that allows retail investors to come in alongside institutional capital, which we think is really interesting for the future. And it's helping us to solve more customer problems. And that's the right reason to do it. We've resisted the temptation to do it just to get big fast. In fact, the platforms that have done that have really suffered in our space. So I'm glad we didn't.
Well, I think it's terrific that you guys have that disciplined focus. I want to talk about some kind of macroeconomic things that's affecting retail as well as institutional investor types. Is as we approach potentially negative real interest rate environment, what does that mean for your borrowers? And also, as we transition to a recessionary decline, what does that mean for your deal flow?
So what I have learned about real estate markets through the ups and downs is that he with the best liquidity wins. Because when a recession comes, that creates opportunity for astute investors. And the real question is, who has the capital to take advantage of that downturn? When assets are trading at a discount to what they were before, who can zoom in and take advantage of that? Who can supply the liquidity that's needed by people who are in a crunch? We intend to be a platform that allows people to take advantage of that. That's true on the borrower side, where our strongest borrowers they're anticipating it. They're waiting for it, right? They're stockpiling reserves, and we want to be there as a financial partner to them for that. We also, on the investor side, we want to create financial products that allow retail investors to participate in that. I mean, the people who really made money out of the Great Recession were the people who had the liquidity to buy as the knife was falling, right? I mean, those are the people who made it. And we think that shouldn't be limited to just a handful of people and institutions. We think that should be a broad-based opportunity. If you live in a place that is suffering from a recession, but you know that there are some bright spots that are being caught up sort of in the cloudiness, you should be able to take advantage of that local knowledge and that alpha and exploit that alpha. So we're positioning ourselves for that in a recession. Now, in a negative rate environment, I think anybody who says they know what's going to happen in a negative rate environment is lying. We've never had this before here. Now, we've seen it in other markets, right? The idea that we're going to pay people to borrow. I mean, it's crazy, right? I don't even know what that means yet. And it may come. I will tell you one thing that we're seeing for sure is a lot of interest in U.S. denominated assets and in alternatives generally. And I think that bodes well for us. So I think if we get into, if some of what's happening globally starts to happen here, I think that will only bid up the sort of asset price inflation that we've been experiencing, and we're expecting more of it in the short to medium term, actually.
Yeah, great response. Thanks for that. We only have about a minute left.
Sure.
This podcast really focuses on innovation as well as innovation failures. So if you could share with us that one product innovation or company innovation that maybe failed and the lesson
Sure.
learned that others can take away from, that would be helpful.
So we've had many attempts to try things that have failed over the years. What can I pick to give you? We try a lot of things around ground floor. So one of the things that we realized as we were qualified to go nationwide, and we wanted to start lending nationwide, and we went out online and we started trying to attract borrowers online. And that was working okay. But we weren't quite happy with the economics of that, and we weren't quite happy with the quality of the borrower that we were getting. So we had a theory that we started testing that was, well, if we could just concentrate our energy locally, well, maybe that would work. And so we started maybe a year and a half ago, we selected a couple of local markets, first Washington, D.C., then we tried it in Nashville, and we had spectacular failures in both of them. We rolled out, we hired a person in Washington, D.C. We said, okay, you're going to be the sales guy in charge of this market. We built his own D.C. branded website. We kind of set him up with like a WeWork office space, right? We had it all set up. And we thought, well, this is going to be great. This is the way to do it. Well, that was an execution failure because it turns out we hired the wrong person. And we didn't support the model right. So then we said, well, okay, what if we tried it remote in Nashville? What if we tried to go after that local opportunity in Nashville, but let's try it with a staff here in Atlanta, and let's just saturate that market? Well, that failed. The online advertising didn't work. The local saturation strategy didn't work. We had some execution failure on that, but we learned a lot. That when we tried it again in Atlanta, within 3 months of kicking off and launching our Atlanta team, leveraging what we learned, it quickly became a third of our revenue. So we're now doing that same approach. I think we're targeting about 6 markets next year, using what we learned, and actually what didn't work in those first 2 markets, but did work in Atlanta. We're now going to try in 6 markets next year. So
can you elaborate a little bit in terms of what worked?
What's that?
Can you elaborate a little bit in terms of what actually worked?
Here's what worked. We were thinking too small. So we were trying to be too agile and too lightweight in these markets. When we actually dedicated not just a salesperson, but a general manager with 1 salesperson that grew to 2 salespeople, and then we added in some operational support that was dedicated to that team, and we set higher targets for what they should generate in order to sort of cash flow it, it actually worked better. Instead of trying to be all, startup-y and lightweight and agile and sort of not really commit, that underperformed relative to when we really put wood behind the arrow. And we were surprised at how quickly it cash flowed. I mean, in Atlanta, it cash flowed in about 2 months. In markets that we're entering, in the future, we model, something like 6 months. But the working capital is not as much as we feared, to tie up. And we're going to see. We're going to see when we do a half dozen markets like this next year, how it goes. But that's what was successful for us, is truly committing, more resources to it, to really put wood behind the arrow.
That's great advice. And on that note, I've been joined by Brian Daly, CEO and co-founder of GROUNDFLOOR. Thanks, Brian.
You bet. Great being with you.